The Federal Reserve just threw the economy and housing market for a massive loop by predicting interest rate cuts in 2024, projecting 3 cuts in interest rates down to a federal funds rate of 4.6%. And these new projections from the Federal Reserve have caused the markets to go crazy, with long-term bond yields and mortgage rates plummeting and the stock market surging. However, what everyone seems to be missing, and what you need to pay attention to, is the fact that Federal Reserve interest rate cuts are rarely positives for the economy. Rather, they tend to directly precede massive spikes in the unemployment rate. Every time the unemployment rate has increased over the last 70 years, the Federal Reserve cut interest rates right before. We've seen this all before, everyone. We've seen this type of euphoria right before things get really bad in the economy. And to see what I'm talking about, let's go back to September 2007. 1 year before Lehman Brothers. What happened in September 2007? That was 1 month after the Federal Reserve first cut interest rates in that news cycle. So the Fed had just cut interest rates in September 2007, and that initial rate cut caused euphoria all over the stock market. Take a look at this article from back then. From September 18th, 2007, stocks surge on the Fed interest rate cut. The Dow Jones Industrial jumped 2.5%. The S&P gained 3%. The Russell 2000 gained 4%. As the market reaction suggested, hallelujah. The decision to cut interest rates seemed to reassure investors back in 2007 that the central bank will do what it can to keep liquidity flowing and to protect the economy from falling into recession. So folks, back in September 2007, people were thinking the exact same thing that they're thinking right now. And that has got to scare you. The delusion going on right now in financial markets is eerily reminiscent of something we saw just 15 to 16 years ago, 1 year before the shoe dropped on the economy. It was 1 year later, the unemployment rate spiked, and then Lehman Brothers occurred, and then it became obvious that we were in a massive downturn. And of course, history isn't guaranteed to repeat itself, everyone. Theoretically, the economy could have a soft landing in 2024. Stock prices could keep going up. Home prices could keep going up. However, when I look at the data, I just don't see how that's possible. Because we have a US consumer that is saving almost no money right now. An average savings rate of 3.8%, near the lowest level on record. So consumers are extremely stretched, ready to tap out. At the same time, the debt levels in the economy are absolutely absurd. Total debt in America has reached $73 trillion between the US government, consumer households, and corporations. That $73 trillion in debt has doubled from what it was only 10 to 12 years ago, and it's now at 265% of GDP. By far the biggest debt load our economy has ever held. And so even if the Federal Reserve cuts interest rates 3 times next year, or even if they cut rates 6 times next year, I don't think it's going to matter too much, because either way, people and businesses are going to continue to refinance that debt at higher interest rates than they had before, and those higher borrowing costs are going to start to slowly and incrementally choke off economic activity in the economy. So I want to show you guys this graph of the federal funds rate in America going back the last 35 years or so to 1990. This is the interest rate that the Federal Reserve sets. Now, I talked a second ago about what the federal funds rate was back in 2007. You could see the Fed cut it down to 0, and that did not matter in stopping the Great Recession. However, I want to fast forward to today. We can see the Fed hiked interest rates basically from 0 in February 2022 up to 5.3% in August 2023, and they've since held it. And now they've held it, and now they're indicating they're going to cut it. And this blue line is indicating what the betting markets are projecting for Fed rate cuts next year. So the betting markets actually think by the end of next year, the Fed is going to cut the short-term interest rate to 3.8%. Now, to be clear, the Fed doesn't think that. The Fed thinks it's going to be more like 4.6, but the betting markets think it's going to be more like 3.8. Either way, the short-term interest rates at the end of 2024 are going to be well above the 0% range they were for the last 15 years, and they're going to be above the long-term average for interest rates the last 35 years. And so that means that interest rates are still going to feel high to people and businesses. Maybe the interest rates aren't high compared to what they were in the 1980s, but they are high compared to the amount of debt that's in the economy right now and how high prices of things are. And so those interest rates are still going to be kind of restrictive in terms of economic activity. And of course, one big question now that a lot of people have is what's going to happen to the housing market now that the Federal Reserve has signaled they're going to cut rates? Well, I mean, the Fed cutting interest rates, that's going to mean that mortgage rates are going to start to go down. And in fact, mortgage rates have already gone down substantially, with Mortgage News Daily reporting that the 30-year fixed rate has dropped from 8% in mid-October down all the way to 6.6% in mid-December. So the mortgage rates have dropped by about 140 basis points. In fact, Mortgage News Daily just reported that this was one of the biggest two-day drops in mortgage rates in decades to send the rates down to the mid-6% range. And so lots of people in the housing market are getting all jazzed up right now. I'm especially seeing like a lot of realtors on Instagram going nuts. They're saying, oh my goodness, the mortgage rates are down to 6.6%. Like, you got to buy a house right now. You guys can let me know in the comments section below if you're seeing that type of stuff out there. But I got to give you all a reality check. And that's the fact that mortgage rates down to 6.6 or even down to 6% isn't really improving affordability as much as you think it would. Because for instance, let's just say that mortgage rates go down to 5.7% by the end of 2024. What would that do to affordability? Well, let's take a look. You can see that that would lower the monthly payment on average in America to around $2,400 a month, down from a peak of $2,800 a month. So no doubt there is an improvement in affordability from mortgage rates going down to potentially 5.7%. It would be about $400 a month or $5,000 a year. That's no joke. That is an improvement in affordability if rates do go in that direction. However, here's the problem, everyone. It's the fact that that only returns affordability to what it was in like August, September 2022, which was already about 4 or 5 months into the housing downturn starting. It only returns the monthly payment to 80% higher than it was prior to the pandemic. So this is still a very high payment, especially relative to income. And if I had to guess, and this is me speculating, I think people are going to be surprised at how buyer demand does not come back as fast as a lot of people are suggesting. Because people are still really struggling out there, everyone. The inflation of the last 3 years has left price levels very, very high. And even with some of those price levels going down, people still can't afford things. The savings rate is 3.8%. The incomes and the wages have not gone up nearly as fast as the home prices and the mortgage payments. And so don't be surprised if, yes, we do see an increase in home buyer demand in 2024. I think for sure we'll see an increase in buyer demand, but I don't think it's going to be nearly as strong as people think. And I actually polled you guys on my channel and basically asked you this question. I said, mortgage rates just had the biggest two-day drop in decades, down to 6.6%. Does this drop in mortgage rates make it more likely that you will buy a house in 2024? Well, only 24% of you said yes. 76% of you said no. And so I think that underscores the point. Yes, we're going to see more buyers next year, but it's not going to be as many as people think. I don't think we're going to go back to bidding wars. And I actually think home prices are going to decline in 2024 because the lower rates, while they're going to bring some buyers back into the market, they're also bringing a lot of sellers back into the market. Don't be surprised if new listings in inventory actually start to spike in the spring of 2024 due to Fed rate cuts and lower interest in mortgage rates, which could throw the housing market for a massive curveball. And I'm seeing more and more people in the housing market talk about. The CEO of Compass, the big realtor brokerage, said he expects inventory to spike when mortgage rates drop. I'm seeing Zillow and Redfin report that they think there's going to be an increase in new listings in the 2024 housing market. So that's a situation we got to pay attention to and watch in the future. What happens not just with buyer demand, but also with listings and inventory. But folks, really the central question I think is on a lot of your minds out there as a buyer investor is, where are home prices heading in your market in 2024? Specifically your city and your neighborhood. Where are prices going? And of course, no one can predict that for sure, but one metric could probably help you predict that is one called sale inventory deficit. This is a metric I just developed and I'm announcing it and coming out with it today. It's a metric that allows you to see how high or low inventory is in your housing market today compared to the long-term average. And what we can see, folks, if we look at this map, is that states like Texas, Utah, Colorado, and Tennessee have a surplus of inventory. There's actually more homes on the market today in Tennessee than the long-term norm. We can see in Texas, there's more homes on the market today. And so if sale inventory is higher than normal, that's a signal that prices are more likely to decline. Conversely, if inventory is lower than normal or substantially lower than normal, that's an indication that prices are likely to remain stable or continue going up. Like, for instance, in Illinois, folks, sale inventory deficit's 47%. Homes for sale in the market are 47% lower than the long-term norm. In New Jersey, the deficit's 52%. In Connecticut, the deficit's 60%. And if we zoom out in America, we can see most of the deficit in inventory is in the Northeast and the Midwest, while the Mountain West regions, Texas and the South, has more normal levels of inventory, which is data that you should definitely check out for yourself on Reventure app. I just launched this data point today on Reventure app, sale inventory deficit. It's a premium data point that costs $39 a month. You can cancel at any time. But what gets even more interesting, folks, is when we break things down by neighborhood and zip code. But take a look at this. You're not going to believe it. If we zoom in on a city like Dallas, what do you see? Oh, is that there's certain zip codes where inventory is double what it normally is, like in these zip codes in red, while there's other neighborhoods to the north in these suburbs, these wealthy suburbs like Frisco, where inventory is down 38% from normal. So in Frisco, there's only 95 homes on the market when on average there should be 150, meaning a deficit of inventory, meaning price is likely to stay stable or go up. Whereas if we go out to Princeton, north of Texas, inventory is way higher than normal, a surplus of inventory, price is more likely to go down. Click back to sale inventory deficit. You can see there's just massive differences depending on where you go in the Dallas metro, which is such an amazing thing, folks. It suggests that it is not enough for you to know what's going on in the nation's housing market or your state's housing market or your metro's housing market. You have to know the trends in your zip code, because literally 5 miles away from you, something completely different in the housing market could be happening. And if you don't know this data locally, you could make a big mistake and read the market wrong. Of course, folks, we do have to pay attention to the macro developments in the housing market, because obviously lower mortgage rates are going to have an impact. We are going to see more buyers come back into the market. We're also going to see more new listings, and these are going to have a huge impact on the housing market in 2024. I'm expecting a pretty volatile year. I think we're going to see prices drop in a lot of markets. Maybe prices will go up in other markets. So if you want to track all that over the next 12 months and look at the data for yourself, make sure you're a subscriber to this channel. Head to www.reventure.app right now, search your city or zip code, and look at what the inventory trends are, most notably the sale inventory deficit, which is a premium data point that you can gain access for $39.